All right, today we are cracking open the books on one of the most beloved companies in the entire design world, Figma. They just dropped their Q3 2025 earnings report, and let me tell you, the numbers are telling a really fascinating and, frankly, kind of a contradictory story. It's a story that definitely has Wall Street scratching their heads. So here's the mystery. On the surface, everything looks incredible. I mean, the product is adored, people are signing up in droves, and cash is flowing in. But then the stock took a nosedive right after the announcement. It's a classic head scratcher. So what we're going to do is play financial detective. We're going to dig right into Figma's official SEC filing to uncover what's really going on. For the third quarter of 2025, Figma raked in $274.2 million in revenue. This is awesome. It shows their whole strategy is working. They're turning all that user love into actual paying customers. But the real story here isn't just the number, it's the growth. So to put that into perspective for you, just 1 year ago, in this exact same quarter, they made $198.6 million. That's a huge jump of almost 38% year over year. In the software world, that is absolutely fantastic growth. It's screaming strong demand and that they're firing on all cylinders. So far, so good, right? And if we dig just one level deeper, we see another really positive sign. For the first time ever, more than half of Figma's revenue, 54% to be exact, is coming from outside the United States. So this isn't just an American tech darling anymore. It's a full-blown global phenomenon. And that suggests their potential market is massive. So with revenue through the roof and global adoption booming, where does this story take a wrong turn? Well, it goes wrong when we stop looking at the top of the financial statement and we scroll all the way down to the bottom line. See, this is where we find out not just what a company makes, but what it spends. And Figma, oh boy, is it spending. And here it is, the jaw-dropping, stop the presses moment from the report. In the very same 3-month period that Figma earned $274 million, it posted a net loss of over $1.1 billion. I'll say it again, $1.1 billion. That's not a typo. They lost 4 times more money than they actually brought in. This is the number that just sent a shockwave through the market. I mean, how on earth can a company with such amazing revenue lose this much money? Is the business fundamentally broken? Well, the answer is actually found in 3 little words that are super important in tech finance: stock-based compensation. You see it all the time with tech companies. Stock-based compensation, or SBC, is a way for them to pay employees with equity instead of just cold, hard cash. Now, while it doesn't mean cash is flying out the door this quarter, accounting rules say you have to report it as a real expense. And as we're about to see, Figma's SBC was, well, it was completely off the charts. Just look at this breakdown. When you add up all the stock-based compensation across every single department, the total comes to $1.14 billion. See a pattern here? That number is almost identical to the $1.1 billion net loss. So this isn't a story about crazy spending on servers or office parties. The entire loss can be explained almost single-handedly by this one giant non-cash expense. So why was it so ridiculously high this quarter? Well, the report tells us exactly why. This quote right here reveals that nearly $1 billion of that expense was a one-time charge directly tied to their recent IPO. See, for years, employees were getting stock units that would only become official once the company went public. Well, the IPO flipped that switch and bam, the company had to recognize all that built-up expense in one single shot. So the key takeaway is a huge chunk of this loss is a one-time accounting thing. But that doesn't mean investors aren't still a little nervous. Because, the smart money doesn't just look at the big, flashy numbers. They read the section of the report called risk factors. This is where the company legally has to tell investors everything that might go wrong. And for Figma, it kind of paints a picture of uncertainty. We pulled out some key phrases for you, right from the filing. Figma flat out admits it has a limited operating history at its current scale. They're moving into new and unproven markets. They even warn that their focus on user experience might hurt short-term results. And then they flag that future stock sales could push the price down and that they might even need to raise more money later. Look, none of these on its own is a giant bombshell, but when you put them all together, they start to build a narrative of risk.
Let's recap. The business is actually generating cash, and it's sitting on a mountain of money from the IPO. Things are looking pretty good, right? But what happens down the road? Can the business fund its own growth without help? This brings us to a really powerful concept for checking a company's resilience.
Answering this one question gets right to the heart of a company's margin of safety. It tells us whether the business model itself is strong enough to stand on its own 2 feet, without needing a constant influx of outside money.
It's a really cool metric called the self-sustainable growth rate, or SSGR for short. You can think of it like a stress test for the business model. It's a way to measure a company's power to fuel its own expansion just from the profits it creates.
And the logic here is actually pretty simple. To be self-sustaining, a company needs to do 2 things. First, it has to actually be profitable, have a positive net income. And second, it has to take some of those profits and plow them right back into the business to pay for future growth.
So, because Figma currently has a net loss, its SSGR is negative. Now hold on, this isn't necessarily a red flag, especially for a young, fast-growing public company, but it is a critical insight. It tells us that their current strategy is to burn capital, specifically investor capital from that IPO, to grow as fast as they possibly can.
Okay, on to our final section, the fine print. After all the big financial tables, there's this enormous section called the Notes to Condensed Consolidated Financial Statements. It looks really dense, but this is where you can find some of the most fascinating hidden gems. I know. This is the part where most people's eyes just glaze over. It looks like a wall of text written by lawyers and accountants, but skipping it is a huge mistake. These notes have all the nitty-gritty details behind the big numbers, and let me show you a couple of absolute gems I found in Figma's report.
You've got to see this. Buried deep in the notes, I found this little nugget. As of the end of the quarter, Figma was holding over $96 million in a Bitcoin ETF. Wow, that is a pretty bold treasury strategy for a software company, and it's something you would completely miss if you only read the headlines.
And hey, remember that risk factor we saw about concentrated voting power? Well, the notes section gives us the cold hard number. The CEO, Dylan Field, controls about 73% of the company's voting power. That's a critical piece of information. It basically means that when it comes to major decisions, one person has the final say. So let's just boil this all down. Here is your simple 3-step guide for tackling any 10Q you come across. 1. Check the headline numbers to get the basic plot. 2. You have to read the MD&A to get the real story and the context behind those numbers. And 3. Scan the risk factors and the notes to find those deeper, often surprising insights. We started all of this with $1 billion mystery, and we found the answer: a massive, non-cash accounting charge tied directly to the act of going public. It kind of leaves us with a final, bigger question, doesn't it? Now that you can read between the lines of these reports, what do they truly tell us about the hidden costs and the complex realities of a company's journey? It's something to think about.